Since they were first introduced, cryptocurrencies have been very hard to predict. If you want to trade these digital assets, this volatility can give you chances to make money. Cryptocurrencies like Bitcoin and Ethereum have increased significantly since they were first introduced. However, now they and other well-known digital currencies have gone down significantly. Expert traders have been betting on cryptocurrency for years, but how do you get started if you are new to the market? Here are some tips on investing in cryptocurrencies and some of the biggest risks you should know about. How to invest in cryptocurrencies in 5 steps. If you want to invest in cryptocurrencies, you first need to get your money in order. This means having an emergency fund, a manageable debt, and, if possible, a diversified set of investments. Your investments in cryptocurrency may add to your portfolio and improve your overall results if all goes well. Pay attention to these 5 other things as you invest in cryptocurrencies. Know that you are investing. You should know exactly what you're putting your money into, like any other investment. When buying stocks, it's important to read the company's annual report and other SEC documents to learn as much as possible about the company. Plan to use the same method for all cryptocurrencies, even though each one works differently, and thousands of them and more are being made daily. You must understand the investment case for each trade. Many cryptocurrencies are not backed by anything, either by physical assets or money. For example, investors in Bitcoin only hope that someone else will pay more than they did for the product. In other words, you can only make money with many crypto assets if the market turns more positive and bullish. This differs from stocks, where a company can make more money and increase its returns. Ethereum, Dogecoin, Cardano, and XRP are the digital currencies that most people have heard of. So, before investing, you should know the possible upsides and downsides. If an asset or cash flow does not back your investment, it could lose all value. Remember that the past is gone. Many new investors make the mistake of trying to predict the future based on what happened in the past. Yes, Bitcoin used to be worth pennies, but now it's worth a lot more. Will this growth continue, even if it doesn't happen as quickly as it does now? This is an important question. Investors don't look at how an asset has done in the past. Instead, they focus on what will happen in the future. What will drive future gains? Investors in cryptocurrencies now want to make money in the future, not in the past. Be careful of changes. The prices of cryptocurrencies are the ones that change the most often. Just a false rumor could cause them to vanish in a matter of seconds. That can be great for experienced investors who can move quickly or who have a good grasp of the market's basics, current trends, and possible future directions. For new investors who don't have these skills or the complex algorithms that guide these deals, it's a minefield. In the volatility market, powerful Wall Street traders try to beat other wealthy investors at their own game. A new investor might find it hard to keep up with all the changes. This is because volatility scares traders, especially new ones, and causes them to leave the market. Other traders might come in at a lower price. In other words, new investors tend to buy high and sell low, but experienced traders can do the opposite, buy low and sell high, making your risk less. Risk management is important for short-term asset trading, but it can be especially important for volatile assets like cryptocurrencies. So, as a trader with less experience, you'll need to know how to handle risk and devise a plan to help you avoid losing money. Also, the method can be different for each person. For a long-term investor, the easiest way to handle risk might be to never sell, no matter the price. Investors can keep the position because they are thinking about the long term. But a short-term trader can control risk by setting strict rules for when to sell, like after an investment goes down by 10%. The trader then sticks to the rule to ensure that a small drop doesn't turn into a huge loss in the future. First, just starting traders might want to save a certain amount of money for trading and only use a small part of it. Even if a trade goes against them, they will still have money to trade with. The bottom line is that you can't trade if you don't have any money. A cash reserve ensures you will always be able to trade. Managing risks is important, but it will hurt you emotionally. Even though it hurts to sell a losing position, doing so can stop bigger losses from happening. Don't invest more money than you can afford to lose. Lastly, it's very important not to put the money you need into risky investments. If you can't afford to lose everything, you shouldn't invest in risky assets like cryptocurrencies or other speculative assets. This is also money. Money that you will need in the next few years, like a down payment on a house or a big purchase, should be kept in safe accounts to have it when you need it. And if you want a return that is 100% sure, your best option is to pay off your debt. No matter how much interest you pay on loan, you will always make, or save, money. There is no way to lose. Last but not least, make sure that any exchange or broker you use is safe. Even if you legally own the assets, someone still has to keep them safe, and that security has to be tight. If they don't think their cryptocurrency is safe, some traders buy a crypto wallet to store their coins offline where hackers and other people can't get to them.